Now I would like to summarize the Black Linneman model related to their estimating procedures, and also I would like to provide you the economic interpretation of the BL model. The procedure of to estimate the we call the mean variance optimization as a allocation based on the Black Linneman model. There's actually 5 steps. The first one is again, right? Just remember is we assume that the global market is in equilibrium. So that's the reason we can first to define the equilibrium weight and the covariance matrix for all asset classes. Right. The purpose of doing that is to calculate equilibrium return and risk for the global market. Then next, once we got the equilibrium weight and the covariance matrix, then we do the reverse optimization. All right, so that we backsolve the equilibrium return. This is very important. All right, the purpose of that doing that is given the optimum uh, weight in the global market and the covariance matrix, then we backward to calculate the optimum risk premium. All right, this we call the reverse optimization process. The purpose is to formulate the expected return of asset on different classes. Okay, now once we have that one, there's one more step, very important, is to identify the risk tolerance based on this called the risk tolerance or risk aversion score. All right. Then apply that, number 4, to calculate the risk, we call the risk premium vector. All right, risk premium vector. So it's actually is the market equilibrium return weighted average. All right. So because we know the risk-free rate, so in fact, to calculate the implied risk premium, actually is calculate the expected return on each sectors. So that's reflect the market equilibriums and the view. And then the final step is using the expected return we already calculate based on Black Litterman model. Then we run the mean variance optimization and define the efficient frontier of the portfolio. Right. So these are the basic concept and procedures for the Black Litterman model. Now, so the result of that is purpose is to develop a stable efficient frontier because the corners portfolio approach does not provide a stable efficient frontier where the Black Litterman model overcome that problem. However, they still have the same limitation as the corners portfolio approach because remember the variance covariance matrix, especially the covariance matrix, still based on the historical data. Right, still the historical data. So that is a historical covariance matrix. Therefore, in some sense, all right, the return you estimate, even though is the reverse optimization, the backward procedure, however, it still implicitly imply that is the ex post approach, not ex ante approach. So during the exam, the discussion about the Black Litterman model, although it's very useful model, still have some strengths and weakness. Now, the important implication here is this: from the BL model, if investor, right, we do not consider just one particular investor. If we're assuming the common investor, then based on the model, the best choice, all right, is put the portfolio into international diversified portfolio with the same weight of asset classes as the global market portfolio. That is the implication. Okay, that's the reason why today's more and more fund managers say that. Well, then we just go ahead hold the market portfolio, global market portfolio, with the same weight given by the market condition. I mean the current market condition, because we view that the global market is on equilibrium. That is the implication from the Black Litterman model. Now, if the investor had a below average tolerance, then we suggest, all right, because the mean variance model with the two-fund separation, then we suggest that investors should hold a combination between the market, global market weighted portfolios and a risk-free asset, still based on two-fund separation concept here. All right, so this is the summary of the Black Littlman model. Now we like to spend some time. I like to spend some time talk about we call economic balance sheet. All right, this is a strategic asset allocation for individual investors. Again, we need to, as long as we talk about economic sense, we need to talk about the tangible and intangible capital. So human capital is a very important part for us to consider the economic balance allocation. Between what? Between the financial capital and human capital. We have spent a lot of time talking about this already, so I'm not going to repeat that, right? But again, is that the the human capital and financial capital, it has reverse relationships, right? Over the time with different ages, as long as so this relationship over the time is a negative correlated. Okay, so how do we find a good allocation between the human capital and financial capital and do a good asset allocation? We need to be careful the calculation of that optimal weight. Okay, now here is an example I want to show you here. Now let's consider 60-40, right, between stock and bond is the optimal allocation. Just assume that. All right, so we're going to allocate 60% of the wealth in stocks and 40% of the wealth in bond. Now here's a question. If we consider financial capital and the human capital together as we call total wealth, then how do we allocate then over the time? So suppose let's think about three different stages of life: 30 years old, 50, and 65 years old. So what do we do? All right, let's think about this example. Suppose that we have this scenario. When age 30, you have financial capital $100,000, and your human capital, right, which is based on the present value of future labor income. Right, so this is a present value of future labor income. Right, so this is not tradable income. All right, this is more like intangible. All right, so this is the 2.1 million. So your total capital is 2.2 million. When you go into 50 years old, then your financial capital increased to 900,000. So financial capital is the value of all tradable assets, stocks, bond, and real estate. And your human capital decreased to, right, 1.3 million. So again, your total capital is still the same. Now go to 65, then your total capital is still 2.2, but your human capital reduced to 200,000. Of course, you accumulate a lot of financial capital. That's $2 million. So, okay, now how do we allocate that? Based on total wealth. And then we want to have optimal allocation 60 and 40. Well, this is a most common sense, all right, the common norm that 60-40 is the best choice. Now, suppose that's true. So how do we allocate that? Now, suppose you are in the age 30 and you have $100,000. Now, remember, we need to do 60-40. So 60% of your total wealth have to allocate into the equity. So 60% of the 2.2 million actually equal to 1.32 million. But you only have $100,000, which is really far behind. You cannot do anything. So what's your allocation? Of course, your allocation is to put 100% of your wealth, right? 100% of your wealth in stocks. Okay. That's the reason if you calculate that, $100,000 of your total $2.2 million total wealth is only 4.5%. Okay, so So we have 4.5 and 95.5. So put 4.5% in stocks and 95.5% it's in the future investment. So you only have 4.5. So the allocation here is like 4.5 versus 95.5. So of course, when you're young, here's the conclusion: is that when you're young, all right, you have low financial capital, for 60-40, put everything in stocks. Hold it for long term. That's in your. We talk about your pension, all right, human capital, including the pension there. Now go to 50 here. In this case, all right, 60-40 case. 60-40, your financial capital is still not enough to put into the 60% of equity, right? You need a 1.32 million, but you only have a $900,000 financial capital. Although this is it's a lot, and you're already 50 years old. But here I suggest you don't worry, put your money into stocks. This is the 60-40 approach, because in that case you're close to 60-40, right? It's a 40.91 versus 59 point, still lag behind 60 because you need a 60% in equity. So fine, put 100% in stock. But when you go into the 65 years old, when you're going to retire, then you can consider that the 1.32 million is lower than the 2 million. Then you cannot put everything in stock. How much? 1.32 divided by 2 million, 66%. So this is already over 60%, right? So that means that if you want to put that one, so you have to put something on bond. So that means you have to reduce the 6% and put into the bond to get a 60-40, right? To get a 60-40, because now the 1.32, it's over the 2 millions already, or over 60%. The 60% have to be 2.2 million. That's the reason you need to put some fund into the bond to make sure that you're still getting the 60-40. All right. So this is a typical example. I want you to pay attention to it. Is that how do we allocate our wealth in between stocks and bond? All right. And depending on your target allocation, optimal allocation. All right. Here is a 60-40. You may consider 50-50 or 40-60. All right. Then, but this simple table allow you to see how do you allocate your 401k, for example, the pension.